Might need to remove this, right? Oh. Yeah. All right. Now, thank you very much for the organizers to inviting us to share experiences in terms of mobile insurance. And basically, the biggest question is how do we rise to the regulatory challenge? I just want us to start from this particular context. And Craig has shared a bit of the Kenyan landscape in terms of mobile insurance. And basically what you see here is a pastoralist in a rural area in Kenya. And what he's trying to do is to send some money, or basically is receiving some money from his son working in the urban area. So he's just checking how much money has been sent to him. At that particular point in time also is looking after the cattle in the field. Based on the numbers and what you will see is that Kenya has a tremendous mobile population, whereby we have 38 million Kenyans out of a population of 50 million that have mobile phones. Over 90% mobile penetration. So much is being transacted online using M-Pesa, and M-Pesa has been one of the highlights in Kenya, basically after at long distance running. So you basically have to look at that, at what we do in the fields, and also what we are doing in terms of the financial inclusion. Now, over 40% of Kenyans nowadays own smartphones, and 14 million users are on mobile internet. So this really gives us a very big step in terms of using technology. Now, mobile insurance, basically what it brings, it kind of enables us to go and manage to get that particular usage. We are able to have significant reach to clients, and also it kind of enables us to have a significant scale over and above a number of issues that come around about it. So one of the biggest issues is that there are a lot that has been changed in the Kenyan market. And the biggest question is that how then do regulators confront these particular changes? That has been a very big question in terms of how do we ensure that we have regulatory framework that really supports innovation due to the ever-changing technological aspects in our markets. So supervisors have to really kind of come up with an appropriate balance, a balance that will enable innovations to come into place, a balance that will also ensure that there are a lot of benefits that are there to the users of insurance products. So what we've been trying to do is, how then do we balance this, regulations and innovation? One of the biggest fear for so many people in the world, especially companies, is regulations. No one really wants to have something as a regulatory standard that you have to follow. One of the biggest also hindrances that you are able to see that many regulators don't have what we call regulatory clarity in terms of how do they perceive innovation, how do they deliver towards ensuring that the economic benefits to their operations, because what we've seen, regulatory systems or standards kind of increase the cost of doing business. How do we enhance the competition? Because you'll be able to see that one aspect that really makes a company gain a competitive edge is by using new new innovations and maybe new products that are quite innovative. How do we also boost financial inclusion? And how do we deliver convenient financial services? So that is a very important aspect that regulators need to think about. And this is all about having an optimal regulation. That's basically an environment that kind of ensures that providers are able to provide products that consumers are happy to buy. At the same time, it doesn't really weaken the financial system, because most of the time you'll be able to realize that innovations can, in a way, weaken the financial systems, whereby after some time you get that the product has failed, this really brings a very big systemic risk in terms of the reputation of that particular sector. So how do you ensure that these particular aspects are within that right balance? So there are different approaches that we've taken within the Kenyan space. And this is all about embracing the change. And when we talk about that change, what we've seen in the market is that innovation has been taken as part of the regulatory culture. We encourage innovation. We in a way, familiarize with the new trend as a regulator. And this really brings up a very important aspect whereby companies can see the potential future in terms of how do they share the new ideas that are coming within that particular space. So it's quite important to have a regulator that thinks through and also embraces that particular change. Second aspect is more of having that collaboration. And you'll be able to see that there are different approaches that have been taken in the past within the Kenyan space. And one of the items that you will see is that we've seen what we call microinsurance regulations being developed. We've seen the regulator in Kenya basically licensing the technological service providers, the mobile phone operators, as form of intermediaries. So within that particular channel, you allow those particular providers to operate within a certain framework. Also, there's a lot of what we call partnerships with different players in the market. And these, what has been done is, there's what we call service level agreements between maybe an insurance company that is a risk taker and also maybe a technological company that kind of provide that platform. What the regulator really needs to understand is what are the level agreements that these particular partners have put in place. So what we've seen is that this collaboration therefore enables us to kind of provide an informal advice on the first stage. Thereafter, trying really to understand what that particular company is trying to provide. And that has been enabled by having quite a modernized regulatory standard or framework, which we call risk-based supervision framework. And this particular framework looks at the scale and the nature of the business strategy that companies have put in place. Another thing is that we are currently coming up with what we call a regulatory sandbox. And what this really means is that we are coming up with a safe space in which businesses will be able to come up with innovative products, different services in terms of distribution. How do they deliver that without really incurring normal regulatory consequences? This really spurs innovators and accelerators to come into the market space. Within that, what we realize is that some of innovations might not really only fit within the insurance space. They might go wider than insurance. You might get that it's a change that is affecting the technological company. It's a change that is affecting the capital markets. So what we've done is that also financial sector regulators are coming up with a policy framework to ensure that if there's an innovation that is cross-cutting, how will this be coordinated within the financial sector? Another thing is that we've been working on innovation hubs, and this is basically to encourage innovation teams, not only at the regulators' residence, but also within the insurance company. So we, within this particular space, we tend to monitor trends and market activity that tends to build and maintain relationships towards InsurTech players and identify those potential scenarios that will increase partnerships. So at the moment, the biggest question is that can we really manage to get to that particular level whereby each and every person within the Kenyan space has some coverage? The answer can be yes, the answer can be no, but is it only through technology? So what we've been trying to do is that we've been trying to kind of pick the consumer needs to be at the forefront, and that is embedded with what technology provides in ease of of doing that particular business. As a regulator, also been participating within the Inclusive Insurance Lab, Innovation Lab, and this basically a sequence of national workshops and international platforms whereby key stakeholders meet to discuss the future of the industry. How do we ensure vulnerable businesses and people have some form of coverage? Just to conclude, this is a very difficult balance to maintain in terms of the regulatory field. Once the regulator really provides that clarity, the biggest question is then how do we balance the two? How do we ensure there's consumer protection at the same time there's market development? Technology will drive on the market development side, but what the regulators are highly concerned with is how do they ensure that the consumers are protected. So unless regulators understand this particular context, it will be very difficult to ensure that the market is growing to a particular standard, because most of the time they'll be highly concerned with the issues of how do we protect our customers, not really understanding how do they continually develop the market. So if a regulator or a regulatory body enables this particular aspect, then it means that we are going to manage that particular growth in terms of enabling innovations and innovators to operate within the market space. Now, this is a question. Yes, my question was, could technology lead to financial exclusion? And maybe you can access that. Yeah, so, okay, perfect. So my question was, could financial or technology lead to exclusion, financial exclusion? Yes, the answers were yes, no, and still unsure. Hands up for yes. Could lead to financial exclusion. Yes, exclusion. Not inclusion, exclusion. So how many are for yes? How many are for no? How many are still unsure? How many don't have an answer? Whereby you could have left your question blank. So I think it's quite interesting to kind of look at that particular question. Technology, most of the time we link it to what we call financial inclusion, but it can go both ways, dependent on how you want to look at it. So for instance, for technology that is highly driven by mobile phones, in a way can lead to financial inclusion, whereby you can be able to reach, you can have a greater reach. But if you look at things like, say, telematics, whereby maybe some persons might not be insured based on their risks. If you look at health gadgets that currently most of us have, it can lead in a way to some people being excluded in coverage. So it's something that will really depend on which aspect of technology we intend to push as a market. So it's not only that technology will lead to inclusivity. One thing is that we may need to ensure that the needs of the clients are met. We need to create that client value to our consumers, and also ensure that their insurance needs are what we highly focus on. So technology really comes as an added advantage to make it easy for an institution to run its operations. Thank you.